Hey everyone, welcome back to POA for you. My name is Leroy and today I'm going to do something different from my other videos. I'm going to introduce to you guys the fundamentals of principles of accounts. And whether you are an N-level student or an O-level student or just someone who's interested in understanding accounting, I think this will be super helpful for you. So let's get right into it. Hang on, before that, if you think that a friend of yours could benefit from this video, please share it with them. This is a free resource and I want it to reach as many people as possible. And if you have any questions along the way, please feel free to reach out to me through this channel or through email. My email address is poaforyou@gmail.com. It's always at the bottom left or bottom right this time of the presentation that I'm going to go through with you today. All right, so without further ado, let's get right into it. So the reason why I'm doing this is because, a lot of you guys get confused about the different questions that you get, and you don't know how to piece the different small information or questions together to see the big picture. And the big picture is so important to get perspective of things, right? And I'm gonna tell you like how the different things that you've heard, whether it's journal entries, ledgers, statement of financial positions, trial balance, all these come together. Okay, and I've done it in a diagram here where we start with an input to a process, the starting point, and finally it gives you an output, which is the deliverable, right? The end of day, that's what it is, right? To a lot of things. And the input of things starts with transactions, and transactions would be something that you buy, something that you sell, or the business buys and sells, or decisions that the business makes. Then these decisions would then translate into accounting entries and what you call the double entries, and these double entries would then flow into they would be updated in different ledgers, right? Whether it's the motor vehicles ledger, the general expense ledger, the sales purchase, journals and stuff like that. And at the end of the day, whatever's updated, whatever's left in these ledgers would then be summarized in a trial balance, which is essentially a summary of all the different ledgers, and then it will flow into the income statement or balance sheet, or what's known today as the financial performance, or a statement of financial performance and statement of financial position. Okay, so I'm going to go through one by one each of this, what they look like and what they are and how they would impact the whole flow, and hopefully this would help you. So firstly, transactions. What are they? Transactions are something that represents activities and actions. So it could be out from a decision, it could be something that the business did. So I've listed down 3 of these examples. When you pay for general expenses, that's an action, right? When you buy a motor vehicles, that's an action. When you sell things, that's an action or an activity for the business. So each of this will result in a journal entry, right? So let's take a look at what kind of journal entries would I be talking about. So the important thing about understanding these transactions is that you got to understand what's happening and how it happened. Then it would help you determine the kind of journal entries that will result. So journal entries, before I kind of talk about the relationship of these two, let's talk about what journal entries or double entries are, and they are essentially the same thing, right? They are debit something and credit something, and this debit and credit has to be of equal value, and that's how the accounting rule is, and that rule is set up based on this premise. Now, following the first examples that we had, paid general expenses of 20,000 by check, you need to understand what's happening and how it's happening. So what's happening is they're paid general expense, right? And how it's happening is they're paying it by check. So the 2 accounts that immediately comes to mind is general expense will be impacted. And then the next one would be check. If you pay something by check, then cash at bank would be impacted. So therefore, you would debit general expense and credit cash at bank. Now, still don't understand why I come to that conclusion? Then you need to understand the following fundamentals. What is debit nature, what is credit nature, and when you talk about assets, liabilities, equity, expense, income, where do they fall in this whole piece of statement, financial position, performance, etc. right? And what happens if something is debit nature or credit nature? So let's start with things that are debit nature. Would mean that if you want to increase a balance of this item, then you debit it. So for example, in the earlier example, we said that we incurred general expenses. So when you incurred general expenses, you want to record that your general expenses actually increased by 20,000. And general expenses in my table below here is an expense. So expense would be debit nature. So if I've incurred additional expenses and I want to record this increase, then I would have to debit it, right? And similarly, earlier on, I paid this by check, which means when I pay something, then my bank balance will go down, right? Because I paid it, right, through my bank. And cash at bank is an asset because that's what you own. And then if you want to record a decrease, you credit it. And that's why we debited general expenses and credited cash at bank. Okay, so this table is fundamental. You need to know this. So let's test whether you've understood this, right? So the next one is, oops, excuse me. Before we go into more examples, actually, I'm going to show you in this table here. I've actually listed what are some examples of assets, because sometimes you're wondering, okay, what are assets? Right, so these are quite a good list of assets that you will see in your examinations. So it starts with non-current assets, motor vehicles, fixtures, fittings, machinery and equipment, then cash at bank, cash in hand, inventory, blah blah blah. So all these are assets. Now income receivables, a lot of people would ask, why is this an asset, right? Because anything that is receivable, it belongs to you. So anything that you own is an asset, as simple as that. So income receivable is, for example, you're renting out something, right? And the tenants haven't paid you yet, but you've earned it already because the month have lapsed. Therefore it's something that you should be receiving. So it's an asset because you own it. Expenses are also, these are the list of expenses, right, that you could possibly see in your exams, right? So cost of sales and right up to, general expense, utilities, motor vehicle expense, depreciation expense, impairment loss on inventory or trade receivables. So get familiarized with this list, and hopefully this would help you kind of know where to bucket these as you see them. Expenses go into, naturally, the statement of financial performance. For these items, asset and expenses, they are debit nature, so always debit to increase, credit to decrease. The next category or part of the table, liabilities. Liabilities, there's non-current and current liabilities. So this is a list that would be quite familiar to you when you start looking at examination papers. Income received in advance. Why is it a liability? Because you receive an income, but it's in advance, so you've not earned it yet. Which means actually by right, the amount that you receive, this amount that you receive does not belong to you. It's something that you owe whoever that paid you in advance. So you should by right give it back to them if, let's say, something happens and you don't fulfill the income generation agreement, right? And income generally is also belongs to this credit nature items, right? So sales revenue, service income, and different types of income. Okay, and all these liabilities and income always credit to increase and debit to decrease, and they are credit nature. So in this slide, we'll continue from the previous examples that we've seen to test whether you kind of understood what I've been saying, right? So purchase motor vehicle for $50,000 by check. And you should be hearing what happened, asking yourself what happened. So they bought a motor vehicle, and how did it happen? They paid by check. So motor vehicle would be one of the double entries, and the cash at bank would be the other, right? So what happened and how it happened. So this would be my transaction because motor vehicle is an asset. I want to increase the value of motor vehicles by 50,000 because I bought it, so I'll debit it. Cash at bank will go down by 50,000 as an asset, and therefore I credit it because these are debit nature. Okay, so $10,000 worth of inventory for credit for 15,000. Try this out. Pause the video and try it out. Now you should get this set of double entry, this is probably one of the few journal entries or transactions that will lead to two sets of journal entries. One set to record the sale, because you would have accredited sales revenues because you have additional sales of $15,000, and sales revenues is an income, and that's credit in nature. And you would have debited trade receivables because you have sold it on credit, and therefore trade receivables would have crystallized. That would increase, that's debit in nature, so you would debit it. Now you would also have to take into account the inventory movement. So you credit to inventory because inventory is an asset, and when you sell it, your inventory goes down because you've sold it now, right? You've given it to someone else. And you debit it to cost of sales because this inventory now moves into the statement of financial performance as a direct expenses that would be eventually compared with the sales revenues to give you your gross profit. So from here, you can actually tell that your gross profit is $5,000, right? Because 15,000 minus 10. Okay, next, leisure updates. Leisure, this is where all the double entries or the journal entries that we've done, where debit something, credit something, it would be updated in leisures. And each of these accounts or this debit, whether it's sales, cash at bank, motor vehicles, they would have individual ledger books, right? And when we say debit motor vehicles of 50,000, this 50,000 actually goes into this motor vehicle ledger in the debit side of it. And in the credit side, you would notice that this says in the description, in particulars, it says cash at bank, because it will always reflect the other side of the journal entry. Okay, so in the motor vehicle leisure account, it will go to the debit side of the motor vehicle. That's why we debited motor vehicle. But the particulars, you always put in the other entry, cash at bank in this case, right? And for cash at bank, you would put in on the credit side, but the description would put motor vehicle, which is the other leg of the journal entries. All right, so this is an example of a balance sheet type of ledger account where you would start with balance brought down. Usually you have an amount, and then this is a debit balance, so it's usually put debit here, and then you debit this. This will add to 84,000, and then if that's the only transaction for the year, then the account closes and it brought forward in the new year, January 1st, the following year, for the total amount here, right? So journal entries get updated into ledger accounts. Then we have other examples that I show you here. General expenses will go into the general expenses as a debit side. Again, the description is cash at bank, which is the other leg of the journal entry. All right, and for this general expense it's an expense account which goes into the statement of financial position. It will not carry on as a balance brought down year after year. Instead, it will be close to the profit. It will be close to the statement of financial performance account, and the particulars will always be closed off as profit and loss. So you bring it to the statement of financial performance account when you prefer to have a ledger like that. So that's the difference between an expense type of account versus a balance sheet type of statement of financial position type of account, which you see here as a cash at bank ledger. Okay. Now, this may be a bit confusing. Take some time to absorb it. If you're not sure, rewatch the video. But if you're really not sure, reach out to me via the channel or email me at poa4u@gmail.com. Email's at the bottom right. Okay, moving on. The trial balance, what is that? So it's basically all the different ledgers. You're combining it into one sheet of paper and telling you that what are all the accounts that I have and what is the balance. As simple as that. So you would have a mix of assets, liabilities, income, revenues, expenses, equity items, right? This is standard in paper 2, question 1 of N and O level examinations. So make sure you understand what you're looking at. So the question here is, how do these numbers come about in the trial balance? Remember, the input for the trial balance is the ledger. So if you look at the ledger, that's something that we've done earlier in a couple of slides earlier. This balance of 84,000 in the motor vehicle ledger will drop into the trial balance. So each of these items in the trial balance have their own ledgers. So general expense 39,700, cash at bank 24,300. Let me put this up. 24,300 it will all be reflected here, right? So just to bear in mind, the ledger is an output of double entries or journal entries, because journal entries would influence the balance in the ledger, and whatever that's left in each of these ledgers would then flow into the trial balance. Okay, so let's see what's next. The income statement or statement of financial performance, and the balance sheet or statement of financial position. So what are these, right? So the thing is, these are statements that come from the trial balance, and the trial balance will contain things like expense, revenues, asset, liabilities, and what is the other one? Equity item. Now, the income statement or the statement of financial position is the one that compares the revenues and income with expenses. So if you have excess revenues and income versus your expense, then you make a profit. If you have less revenues and income versus your expense, then you make a loss. So that's as simple as that. The statement of financial position on the balance sheet tells you is a display of your assets, your liabilities, and your equities. So it's basically what the business owns and owes, right? Assets is what they own. So things like motor vehicles, things like trade receivables and inventories, these are what they own. Things like what they owe would be their trade payables, things like their income received in advance, or even equity is actually what the business owes to the shareholders or the owners, right? If you think about it that way. Okay. All right, so let's move on to the next slide and see what I have here for you guys. So this is showing you how this trial balance, some you have, like we said before, there's asset, there's liabilities, there's revenues, there's expenses in here, and this section that I've highlighted here is relating to expenses, revenues, and income, and these items will go into the statement of financial performance or the income statement. So it's important that you identify or know in the trial balance what items are these. Are these assets, liabilities, income, revenues, expenses? Because once you identify them, then you know that these will flow into the statement of financial performance or the income statement when you need to prepare one. Right, so I've done this in a format like that, and this format is available in your syllabus notes. Go Google your syllabus notes. It should be available online, and it's usually at the last pages of the syllabus notes. And if you can't find it, or if you need help, write to me. I'll be happy to guide you to where you can find it. Okay. So in here, revenues is always the first part, and then you get your less your cost of sales, which is your direct cost. You get your gross profits, which is your direct profits from the sale of the goods, and then you have rent received, which is other income, and expenses. Okay, then all these are bigger than the expenses. Your gross profits is larger than the expenses, so therefore you have a profit for the year. And so after you get your profits for the year, it's time to look at the balance sheet or the statement of financial position, right? And these are the rest of the items, which are either assets, liabilities, or equity. So look through these items to see whether you agree, whether they are things that the business own or owes, not the expenses, revenues kind of related items, all right? So this will always go to the financial position statement. Now, it will flow into a statement like that, and that's the statement of financial position on the balance sheet. The format is again in your syllabus outline. Go Google it. If you can't find it, reach out to me. I'll be happy to help. Okay. It starts with non-current assets, and these are assets that are a bit harder to liquidate or convert to cash, right? Because it takes a long time to sell, you know, your motor vehicles, your equipment, your buildings and buildings and stuff like that. But current assets, which are easily convertible to cash, is easier, like inventory. If you are selling books, it's easy to sell the books, right? Because your business is selling books. So that's why they are classified like that. But shareholders' equity and retained earnings are part of equity items, and retained earnings retained earnings actually means earnings retained from current year and from the years before, right? And it could be loss, it's accumulation of loss and earnings, profits and loss from the time the business started to the time today, right? And in this case, prior to this period or this financial period, you have a retained earnings of 18,000, and this period your profit was 105. So you add a total of your cumulated earnings, it's 123. So of course, retained earnings will be ending retained earnings will be the beginning retained earnings plus profits, and or minus losses. If you have a loss, you have to minus from that. All right. It's not retained yearing, it's retained earnings. Sorry for the typo. So I hope this has been helpful, because I think you need to understand this flow that we talked about in the earlier slides, in the beginning slide, right? This flow is super important, and I would urge you to go through this and make sure you got a good grasp of this whole thing, right? Again, if there's any questions or anything that you guys want to ask, it could be related to this presentation or otherwise, let me know. All right, my email address is on the bottom right of this screen, and I've got other materials that you guys could find useful as well. Share this with your friends. Free resource for everybody. Hope it becomes useful for everybody as well. Take care for now.